Hello and welcome to the Joe DeLisi Financial Advisor Podcast. Today we get a quick one on the topic of stagflation. Stagflation and your money. Before we do, please hit that subscribe button. It helps me know which episodes are downloaded more, and based on that, what are the topics that you really value the most. This podcast is really just meant to be sort of an additional piece to current clients to refresh your memories of things we've talked about, reinforce ideas and concepts. And for those of you who are new, though, and maybe not clients already, you can go to the show notes, and there is a link in there where you can fill out some real brief information. It gives me an idea of who you are. And if you'd like to talk, see if I can help in any way, you can go ahead and request to do so. So for today, we're going to talk about stagflation. It's been in the press for a bit. In fact, by the time that this podcast is published, it might even already be gone. That's how fast these things kind of come and go. Now, last podcast, we spoke about the media and how media want you scared. And they'll do it either through fear or greed. And obviously, stagflation, that term is very much a fear term. So let's get into it a little bit, just a data point or two to kind of help you, see that term and really just sort of move on. So if we've learned anything really over the past few years or decades, is that, as we said, the media, it's just really good at scaring us. It's their job. The current thing, at least as of recording, is to be afraid over stagflation. Now, I've double checked with the CDC, and you don't have to wear a mask. You don't have to worry about that. There's nothing you got to do. It's not going to help beat stagflation, but there is a vaccine we can take to help to beat it. And that vaccine is just really a healthy dose of equities. So what is stagflation? Well, according to the Oxford Dictionary, it's a persistent high inflation combined with a high unemployment and stagnant demand in a country's economy. So at its core, stagflation is just a really crappy economy. The media and some economists believe that we are either in a period of stagflation now or we are headed that way. And look, I'm not here to argue that the economy is good. I don't think it really is. But that's a very different, thing than throwing around a term like stagflation to try to scare people. So what does it mean for your balance sheet? Well, for today, let's just focus on one area of your balance sheet, and that would be your stock portfolio, your equities. And while some in the media are going to tell you that stagflation means your returns are going to be zero at best, we just simply can't believe everything they tell us. So a quick Google search over 1970s stagflation will lead you to articles and videos suggesting that in the 1970s, there was a flat or even a negative stock market. But this isn't true. It's not even true if we price in the cost of the CPI, or the Consumer Price Index. So for instance, if you look at 1973 up to 1980, the Consumer Price Index averaged about 8.2%, and over the same time period, the S&P 500 only rose 3%. And that source is the S&P 500 index. So with that one data point alone, yeah, you lost money. But as you know, if you're a client of mine, the S&P 500 index is not the market. It's one market. So what about some of the others? Well, what about small cap U.S. stocks in that same time frame? Well, that market rose 16%. And that source is Ibbotson, Small Stock Index. These would be like small growth companies is what that would be. What about small cap U.S. stocks? What about small cap U.S. value stocks? So those rose almost 18%. And that source is Fama French, which is the Small Value Research Index. So even if you price in CPI, you significantly you had significant returns during that time period. It's just you have to be diversified. You have to have more than one market. Now, this is really critical right now, right? Because I just quoted you the S&P 500 during that time frame that really didn't move that much. And there have been significant periods of times, 5 years, 10 years, even up to 15 years where the S&P hasn't had really any return. And there's more time periods where the S&P hasn't given you any return if you price in CPI. And that's why we have other equity markets at play. U.S. small growth, U.S. small value, international small cap, international small growth, emerging markets value, emerging markets small, and on, right? So you need a diversified portfolio, not because we're trying to beat anybody, but because we don't know which markets are going to perform and when, right? So we have to spread the money out to kind of smooth out that ride. So do we want stagflation? Of course not. We want a robust economy where everybody does well. That's healthy. We want better paying jobs. We want large salary growth. We want low taxes. We want free markets to deliver excellent investment returns for equity investors. But the worry that it is inevitable that you're going to lose money during a poor economy in your stock portfolio, it's just rarely true. Stocks in any given year may be up or down. However, in a well-diversified portfolio in those many different markets I just mentioned and in many different countries, you have historically been in a position to make good returns net of inflation if you just simply stay the course. So, should you be afraid of inflation or stagflation? Not necessarily. The question is, have you built up your cash holdings in things like cash value, life insurance, savings, other assets? If you have, then you're able to keep your equities invested in the markets so that you're not only are okay in poor economic times, but that you're positioned to do potentially really well over those poor economic time periods. People have referred to this before, that you have to own assets. And so even when the economy is bad, those who own assets will do well. So what's the simple takeaway? Well, keep your savings rates high. Keep your liabilities low. Continue to allow us to rebalance during poor stock years into all the available markets, and then let time do the work for you. And that was it. Quick and easy, right? Stagflation, no worries. You can brush that off if you've done the work. If we've sat down and we've looked at your risk tolerance and standard deviation and what you can deal with in terms of volatility and movement. If you're able to be coached by somebody like me and stay the course and look at your entire balance sheet. If you've done that hard work and you can stay the course, there's really nothing to be afraid of. Time for compliance. Registered Representative, Financial Advisor, Park Avenue Securities, LLC, Pass OSJ 5280 Carroll Canyon Road, Suite 300, San Diego, California, 92121, 619-684-6400. Securities products and advisory services offered through Pass member FINRA SIPC, Financial Representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. Pass is a wholly owned subsidiary of Guardian Westpac Wealth Partners, LLC, is not an affiliate or subsidiary of Pass or Guardian. Insurance products offered through Westpac Wealth Partners and Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC, California license, insurance license number OD34103. Arkansas Insurance License Number 2195027. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. Indices are unmanaged, and one cannot invest directly in an index. Past performance is not guaranteed of future results. All investments contain risk and may lose value. Equities may decline in value due to both real and perceived general market, economic, and industry conditions. Investing in securities of smaller companies tend to be more volatile and less liquid than securities of larger companies. Investing in foreign securities may involve heightened risk, including currency fluctuations, less liquid trading markets, greater price volatility, political and economic instability, less publicly available information, and changes in tax or currency laws. Such risks are enhanced in emerging markets. The Consumer Price Index examines the weighted averages of prices of a basket of consumer goods and services, such as transportation, food, and medical care, and is a commonly used measure of the rate of inflation. S&P 500 index is a market index generally considered representative of the stock market as a whole. The index focuses on the large cap segment of the U.S. news market. This podcast is for informational purposes only, is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and firms are not affiliated with or endorsed by Pass, Guardian, or Westpac Wealth, and the opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. Georgia. By providing this content, Park Avenue Securities, LLC, and your financial representative are not undertaking to provide investment advice or make a recommendation for a specific individual or situation, or to otherwise act in a fiduciary capacity. 2024-174-134 expires 5/2026.